What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are breaking down the latest GDP Now prediction from the Atlanta Fed. And on the surface, it looks amazing, but we're going to dive into a lot of things as to what to consider, what to keep track of. So if you're excited for today's video, as always, feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future uploads. Now, the GDP is the gross domestic product, basically focuses on how much our economy is growing in the U.S. The bigger the number, the more we are growing and expanding our economy. The smaller the number or into the negatives means that we are slowing down. Our economy could be going very, very slow in the foreseeable future. Now, what we're looking at here is the Atlanta Fed as of today, June 9th, says the latest growth for the GDP is estimated to be 3.8%, as you will see right here. 3.8%. That's amazing. Surface level. That's amazing. But we have some things to talk about, some things to break down about, so that we get the full picture as to why they have this estimate of 3.8%. All right. Now, what you might remember is from a while ago, we were predicting GDP to come in low. In the previous videos of Fridge Financials, we're looking at GDP coming in low. And believe it or not, it actually came in negative. Some people say negative 0.2, some say negative 0.3, but it came in at negative. And one of the key signs of what people call a recession, the recessionary period, is if you have two negative GDP growth quarters back to back. Quarter one was a negative GDP growth. It's contracting. If quarter two comes in negative, then that's a huge shock to the economy. We're thinking about, we're in a recessionary period. Stock's going to go down. Money's going to go, it's going to dry up and all those kind of things here. And you're sitting there saying, well, Fridge, we're looking at 3.8%. That is amazing. We were at negative 0.2. The economy is booming. Things are doing amazing. And the idea here is to bring forth to light that if any article, any news thing, or anybody that talks to you says, look at how high the GDP is, you got to be careful. And here's why. If you take a look down into, this is their breakdown of the releases and their data and everything of that nature. So here's your GDP coming in negative 0.2, right? From April 30th when it was released, that was for Q1 of 25, negative 0.2. Okay. Now we're looking at, 3.8%, 3.7. It was as high as 4.7. It was amazing. We're looking at all this growth, looking at this Fridge. What are you talking about? Look at the growth. But there's one thing here that we really have to factor in. And the big thing that impacts GDP that people tend to leave out is how it's calculated. Now, we're going to go back and forth on these charts here. GDP, how it's calculated. Boom. It's consumption plus the investment plus government expenditure plus net exports, which is your exports minus your imports. The key thing to factor in here, and I'm going to zoom in even more, close and accept, is this, minus your imports. These all add together to create your GDP. But what is it that pulls GDP down? What is the only thing here that takes away from the GDP value? It's your imports. Right here. You subtract the imports from the exports, gives you the net exports. So you're still adding that in, but you got to subtract the imports. Okay, well, Fridge, all right. Sure. Look at this. At Q1, this number is astronomically high, 42.6 of imports. Why is that the case? What is the purpose of this? Companies, again, remember, we're talking Trump administration tariffs now and everything else. Companies were front loading their inventory before tariffs took part. They knew tariffs were coming. He was talking about it and they're going to start on this day here. They're going to start on this day here. These companies knew they were coming. So what do? They front load and they load up on their inventory. They front load it. 42.6 is their number we're looking at here. They front loaded their imports. Look at the numbers after that. 5, 4, 4. -11 now, -9. Now, we went from very, very big positive, 42.5, to now a very, very big negative. Why is that the case? Well, things to keep in mind about, right? We front-loaded imports, which has a huge pull down in our GDP. And I have a visual here to show you. Look at this huge pull down that you're getting from the GDP because of those imports. This blue rectangle right here is pulling that GDP down. And it's a huge blue rectangle compared to anything in the last 2 to 3 years. Because companies were front-loading imports to offset the tariffs that were going to be coming in from the Trump administration, right? Look at this. Real GDP growth, -0.2, 0.8%, +4, -0.1, +0.3, -5.2. This literally offsets and pulls the GDP into a contractionary period, which is what we have right now. You had a 5% pull down from the imports because of the front loading of tariffs. And that's what happened, which is what pulled down the economy and pulls down the GDP to be contractions. Okay, Fridge, well, so now what does that mean going forward? Well, think about it. If the companies are front loading inventory with all their imports here, and again, that was having a huge pull down on your GDP because you take away the imports, you have this huge front load happening here. But now you're sitting on a bunch of supply. A lot of inventory is still there. You front loaded it all at the end of Q1. Now Q2 comes around. I got plenty of supply still. Do I need to import things? No, of course not. I still have a huge abundance of supplies here from Q1 before the tariffs went into effect. Now I don't have to import anything else for the longest time. This number is negative, which means it's actually going to push your GDP so much higher because it's so much less imports coming in to the US. So what is that going to do? Well, what that's going to do is it's going to have a prediction of a GDP to be super high, 3%, 4% maybe. That's why these GDPs are being pushed so high, because your lack of imports. There's so much less being imported here, so it's going to push the GDP so much higher than where we were at from before. And that makes sense. Okay, well, Fridge, what does that mean? Well, think about it like a seesaw, right? On one side, you're sitting on the left side, for example, of a seesaw, and you have a heavy amount of importing coming in. Well, once all that importing stops, you're going to flip to the opposite. It's going to reverse. It's going to go to the other side now, which means instead of your GDP being negative, you're going to have a very positive GDP for Q2. And that's what's happening. But now we got to look behind the scenes and look even deeper now, because it's a seesaw right now. It's whiplash, we call it. You're having a whiplash effect where you have a GDP contraction Q1. Now you have a huge GDP push in Q2. What does that mean? And what that means is that we have to look further. We need to look deeper. One of the major things to look at in this data sheet here is your personal consumption expenditure. How much is the consumer spending? And what does it look like? Well, take a look. 3.3, 3.7, 3.7. People are spending. They have this prediction of PCE coming in pretty high. Okay, cool. Good. But now take a look at what's starting to happen. 4, 3, 2.6, 2.5. That's not good. What is that telling me? That is telling me that the personal consumption, again, the consumers who are spending the money, the spending is starting to slow down. And that's not good. If the spending starts to slow down, again, your GDP is being bolstered up by this huge lack of imports, but your spending is going down. That's not good. People stop spending as much money. There's a lot of money circulating in the economy. It can slow the economy down. Even though surface level GDP is showing a booming number, take a look, 3.8. If you look at these ones, 2.4, 2.3, your PCE was almost close to 4. But now you're looking at the 3s, but your PCA is now in the 2 to 2.5s. Not sitting well. And in previous videos, what we've talked about is also the labor market. The labor market is where things will really hit the fan. The labor market starts to turn over. People are working less. less people are spending. There's your economic factor that will shock the economy. And right now, it's not happening yet. In my earlier video, and I'll admit I was wrong here because I sold at the bottom too early, and I completely understand. I will fully admit that until the end of the day. I sold way too early, and I will admit it. The focus now for a lot of investment firms, a lot of private investments, private investors, I should say, a lot of people, the Wall Street analysts, forecast companies, a lot of people's eyes are now on Q3 and Q4. Q2 is just like a whatever kind of thing because Q2 is just like, yeah, we're going to start to see some impacts of tariffs potentially, but we're going to get this huge whiplash of GDP because less imports are coming in. Q3 and Q4 is where you're going to really start to see the data unfold of what's going to happen. And between now and Q3 and Q4, we're really going to see, are we going to be hitting a recessionary period or are we going to have a soft landing with Jerome Powell? The labor market came in at a beat from the expectations, but if you take a look, it is still slowing down. From December, picked up a little bit, but the long-term trajectory of our jobs data is still showing a downward trend. It comes in lower than last month. That came in higher than the previous month, but now we're starting to show that is there going to be a contractionary period for the labor market? Is unemployment going to tick higher? Is jobs created going to go lower? And is that going to be the economic shock that hits the economy? Obviously, only time will tell. Q3, Q4 is where the big impacts you're going to be seeing in the data here. The thing that I just wanted to make a note of for this video is headlines and surface level stuff is not the end all be all. When Yahoo Finance or Bloomberg or Reuters comes out and says GDP comes in at 4%, the economy's booming, we're doing great. Look, we got to look more behind the numbers here because just because this number is great does not signal it's great. So keep in mind, I always like to watch the Atlanta Fed GDP to see what their estimates are going to be at. And here's the thing, before we get out of here, the imports had a negative 5% pull down on the GDP from quarter one. You're going to need to see a huge increase in this import percent change here, 4 to 5% to offset this crazy quarter. If imports only pulls GDP up like 2% or even 1%, to me, that's not enough. We're going to need a huge pull from imports to kind of offset what happened in quarter one. And that is going to be something to watch out for at the end of Q2. So, as always, guys, if you made it to the front of the video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. Thank you guys so much for watching. I hope you guys make money in the market and you're reading into data as much as I am. And as always, I will see you in the next video.